Well, congratulations, everybody. We made it. We made it to the end of the quarter. And so far this year, there's been very good investment returns. And congratulations also, because we've now made it to what is probably the third most expensive level in US stock history. The previous two times were one, around 1929, which was followed by the Great Depression, and two, 1999, which was followed by the tech bubble. You can see here from this chart, it is called the Shiller PE ratio. And what they do for that is they take the last 10 years of earnings, average it out, and see what kind of price you're paying for those ratios. So you'll see a big spike right there in 1929, right before the Great Depression, a second big spike right in 1999, and then today we're at a new third peak. Now, that doesn't mean that there's a huge crash coming, but it does seem to mean that it's unlikely that the S&P 500 is going to produce high returns over the next 5 years or so. You can see here from this chart from JP Morgan that at the present price to earnings ratio of 22, you do on average have positive returns. There's been a few periods where you got negative returns and a few periods where you got nearly 20% per year, but the average is probably closer to 5% per year. Now, what this is being driven by are the biggest couple of stocks in the S&P 500. Now, most people think that when you put your money into the S&P 500, it's going to be equally divided between 500 companies, but that's not true. They weight the S&P 500 based on how much it takes to buy an entire company outright. So you're looking at what does it cost to buy Apple relative to what it costs to buy Macy's. Macy's is worth about $1 billion. Apple is closer to $3 trillion. So right now, the S&P 500 has become extremely concentrated in just the top 10 names. In fact, nearly 40% of your money would go into just 10 names if you put it into the S&P 500 right now. Putting half of your portfolio or nearly half of your portfolio into 10 names isn't what I would call diversified. And you can see here that going back to before the tech bubble, we've never seen the S&P 500 become so concentrated in so few names. Now, I know what you're thinking. You're probably thinking, well, Bjorn's saying the S&P 500 is overvalued and it's concentrated in just a couple of stocks. I'm going to head for the hills and use this to time the market. But you can see here, back to the Shiller PE ratio, that if you try to use this for timing, you probably would have gotten out of the market in probably 1995 and stayed in the sidelines ever since. Valuation does a good job of setting expectations, but does a terrible job if you're trying to time the market. So I'm afraid to tell you that using valuations simply won't work if you're trying to use them to time the market. There's good news here too, though, which is that we don't need to be able to time the market because we know to diversify out of just US large stocks. We don't have all of our portfolio in just those 10 stocks. In any Quarry Hill client, you're likely to have bonds as part of your portfolio. You'll definitely have international stocks, real estate, and small value stocks. All of those areas are trading at normal or even cheap ratios right now. So take a look at this chart here. This chart shows the relative expensiveness or cheapness of the US stock market versus international and developed markets going back to 1989. You'll see the first big spike there. The closer you are to the top of the chart is the more expensive you are. So the first big spike there is the tech bubble in the US, where the dark blue. And then you'll see where it got very cheap in 2008 and then back to expensive today. But you'll also notice that although the US went back to expensive levels, the yellow developed markets and the blue emerging markets have stayed at extremely cheap levels from 2008 and have never increased their valuations. This is part of the reason we're starting to see international and emerging markets outpace the US this year. Additionally, if you look at this chart from dimensional funds, this shows the expensiveness of the large stock sector of the US market going back to 1926. And you can see that, again, we're quite expensive today relative to book value. The bottom line, though, is small value stocks. And you can see that those are trading just at their normal level that we've seen for many decades in the past. So by diversifying into international and small value stocks, a person can be leaning away from these expensive US large stocks while not needing to time the market. If you take a look at this chart shows what would have happened to a portfolio that was diversified internationally with a small value tilt and 20% in bonds, very similar to what most Quarry Hill portfolios are right now. And you can see see how that portfolio performed through the tech bubble versus the S&P 500. So this chart is showing from January of 2000 through December of 2004. And you can see that the green line, which is the S&P 500, lost about 43% at one point, and over the course of those 4 years achieved a negative 10% return, whereas a portfolio that was better diversified into small value, international, and bonds continued to perform very well with a cumulative return of 77% over those 4 years. So what's the bottom line? The bottom line is that over the past several years, the US market has been the driver of most of the returns of many people's portfolio. This has caused them to pour more and more money into the largest and most expensive stocks in the most expensive country in the United States here, while the dollar has continued to strengthen. They've also become extremely optimistic about AI stocks and are hoping that this will justify these high valuations. Historically, when the market is this expensive and this concentrated, an asset like that won't perform particularly well. However, we know we can't time it, and we don't need to time it. Diversification is our protection, and we're going to stay disciplined by staying invested into international bonds and small value. The most important thing to remember is that you can't predict the future, but you can prepare, and discipline is what ultimately drives your returns over time. We're invested alongside you, and we'll be putting our own money exactly where our mouth is. If you have any questions about how any of these things pertain to you, please reach out and don't hesitate to send us an email or a phone call. We'd be happy to review that with you.